welcome to episode 3, guys. If you are still around, that means you must really be interested in knowing how the forex market actually really works. Yeah, so episode 3, and this episode we'll be talking about the brokers. So we talked about them briefly in episode 2, where we were describing to us what role they play in part of helping us place trade in the forex market. So in the previous episode, I explained rightly that we ourselves as individuals, we are retail traders, because the big guys are the banks, the hedge funds, and the guy that trade huge amount of money. But as a retail trader, during my explanation of how the leverage works, and in connection to lot sizes, I talked about the smallest lot size being the smallest units being the micro, the mini, and the standard. So looking at it from the micro perspective, whereby the smallest unit is 1,000 units. So you can say, okay, maybe if you have $2,000 or $3,000, since the smallest unit you could purchase is 1,000 units, maybe perhaps you could use $5,000 to actually trade. But the thing is that if you want to actually even use that $5,000, you use the micro lot size, which is 1,000. Let's say you are using 0.01, which is you are buying 1,000 units of a particular instrument. Mind you, there are some additional charges like the margin that is going to be required is a percentage amount of your capital that is also going to be used by the broker to make sure you are in that position. So while your position or while your trade is actually playing out, there is also a certain limit in terms of when the market starts to fluctuate, because now once the market is fluctuating before it goes in your own direction, that is looking at it from a buy perspective now. So once the market is going up, sometimes it might retrace a little bit to the downward side, and if your account can accommodate these fluctuations, you might end up being pushed out of that particular trade, not because the trader has gone against you or have hit your stop loss, but because you got a margin call. So it just it just doesn't pay unless you have like $1 million, $500 million. Like now you are part of the big boys that can actively play in the market. But as retail traders with your $1,000, $50,000, like you still need leverage from this broker. And apart from the leverage aspect, these brokers are the people that fills in your order on behalf of you. So on behalf of the values you've specified, that is your stop loss, your take profits, they execute this order for you in the marketplace. So brokers, as we've said, they are like the bridge between yourself and the market, the major market. So and as a beginner, what you need to know is that this leverage is to, like, as much as you can see a broker offering you a 1 to 100 leverage it might sound like a blessing, but then most of the times it might be is like a blessing in disguise, because that purchasing power that has been increased, like giving you that bigger leverage. Like say you have $100 and your broker gives you like a 1 to an unlimited leverage. I think there's a broker that does that. I don't know if it's Xness. I think Xness, in terms of ranking too, Xness is like, they are like high above there. So they are one of the most top recommended brokers. I know some other brokers like FBS, OctaFX in Nigeria, but of course I do have I have history with OctaFX, and while I was trading with them, I think their spreads are quite tight. So now, since I mentioned spread too, so this spread is one of a very important factor that affects trading, because spread is the broker's price. That is the spread is the fee between the ask and the bid price. So is a charge they put on top where you are buying or selling from. So for every time you place that buy or sell trade, your spread of the broker is always going to be added to that particular price. So and you might ask, so this is very important when you are trying to break even. So break even is when you are already active in a trade, and you're already active in a trade and you want to basically break even, so that once the trade actually starts to reverse and is trying to take you out, got you are going to get stopped out at break even. That is what we mean by break even basically is you didn't profit and you didn't lose. So if you're not a kind of person that used to break even, that is, you let your profit run and the market reverse and starts to retrace back, it might actually still hit your stop loss. So I mean, why would you want to have such a thing whereby you are already in profit, then the market just reversed and hit your stop loss? Like, we don't do that basically. So this is part of a beginner mistake, but it's something like you should always be a break-even trader. A break-even trader is better than a stop-loss trader, because at break-even you are not actually losing, because you don't lose and you don't gain anything. So it's better off of you actually losing. So brokers, spread matters when you are picking a broker to trade with. So for a long time now, I've actually been more of a proprietary firm trader. So I like most proprietary firm traders too. Some of them operate brokerage services as well. So um, like the one I use currently, or that I've used so far, Funded Next. So Funded Next are proprietary firms. So proprietary firms, basically, unlike brokers, proprietary firms are firms that gives you money to trade on behalf of them. But before they do this, you have to like purchase an account. So they have account of varying size. Like for Funded Next now, they have 6,000 and above, up onto 200,000. But before they actually give you the account to actually trade on behalf of them, you have to do like an exam where you pass step one and step two. The first step is actually to make 8% of whatever account it is you purchased from them, and the step two is to make 4% of that. So once you've successfully like passed each steps, then they give you the account for you to trade with. And upon your third payout, they actually do pay you they pay you the fee that you used to purchase that account. So the fee is more of like 2FA, to know that to check if you actually know how to trade. So, and if you indeed know how to trade, I don't think there's an issue with that, because at the end of the day, they return that particular money that you used to buy that account back to you. So at the end of the day, you don't have anything to lose. You only have something to lose when you blow that account, and your money is gone too. So how broker contributes to the success or failure of a trader is, first off, their market execution. Is it fast enough? Because trading some high volatile pair like gold, so when you click that sell button, is it executed immediately? Because there are some brokers whereby you are trying to buy at when is, let me put use for example, 1 naira. You are trying to buy at when is 1 naira, and before you know, the latency, that is the delay between when you've clicked the sell or buy button to when your order is being executed or filled in, the market price will have already been at three naira, and before you know now, that puts you at a not so good position. Because trading, you have to have the entry right, because once your entry is right, you have a better risk to reward ratio. Also, when you are trying to break even, you have a better chances of break even at a better position, unlike when your order is being filled at a price higher than what you specified. If your order is being filled lower than the price than what you specified, that's usually like it's somewhat a good thing, because now you get to even gain more than you actually defined, as well as you get to lose lesser than what you actually defined. But usually is the reverse, whereby your order gets filled at a price higher than you actually specified. But trading with a broker that has a very tight spread will help you get your order executed at the price you specified. So this is very important. Then also slippages. Slippages is basically gaps that happen in the market, and this usually happens when during the close of the market on Fridays and the market open on a new week on Monday. So these gaps these gaps are usually crazy. Like, is for me, I advise you just um to not trade. Like, you should not hold your trade over the weekend, because it's very risky. If it's going to go against you, you are going to be losing massively. But I don't know, once it goes in your favor, that gap doesn't translate to you gaining more than you have actually, that is once the gap extends beyond your take profit. From my experience, I don't see more money is actually what you have actually specified to gain. But once it's the reverse, whereby it goes against you, you get to lose massively more than what you actually specify. So gaps to like slippages, sorry, is one of the things that you should try and avoid as a forex trader, because usually it's going to be against you and not in your favor. So a quick recap: brokers are just like third parties through which we execute our trade. They execute our trade on behalf of us in the larger market. And uh, what you need to look out for once you are choosing a broker is a broker with very tight spread and fast execution rates. So those are the two things that are most like are very important. So you as a trader, or you as a newbie, once you just sign up with anyhow trader, anyhow brokers, like, they can also contribute to the frustration, or like your experience in trading, basically. So I think that does it for this episode. And subsequently, whatever it is I forget to mention, is going to include it in the next video. So thank you, and I see you in the next episode.